So you're planning for retirement, right? But what about the costs you don't see coming? Long-term care can be a massive financial curveball, but it really doesn't have to sink your plans. In this explainer, we are going to break down some seriously smart ways to make long-term care insurance in Georgia actually affordable for you. All right, let's just cut to the chase with the question on your screen. Do you think waiting to buy long-term care insurance is a good move? It's a really common thought, right? Oh, I'll deal with that later. But as we're about to find out, that's an assumption that can be a very, very expensive mistake. And this chart just says it all, doesn't it? I mean, look at these numbers. At 60 years old, you might pay about $95 a month for a policy. But if you wait just 10 years to age 70, that very same coverage could cost you over $212 a month. That is more than double. The price of procrastination is real, and it is steep. Okay, so here's our game plan. We're going to talk about the high cost of waiting, why timing is absolutely everything. We'll explore some cool hybrid policies, and then get into how you can customize your coverage. And finally, we'll land on the one key takeaway you really need to remember. First up, the high cost of waiting. And let's be super clear here. We're not talking about some slow, gradual price creep. No, these jumps are sharp, and they happen way faster than you would probably expect. Okay, check out this number because it's a real eye-opener. 43%. That's how much your premium can skyrocket in just 5 years, between the ages of 60 and 65. Just think about that for a second. It's a huge financial penalty for a relatively short delay. So, how do you get around these massive price hikes? How do you stay ahead of the curve? Well, it really all comes down to one incredibly powerful idea: timing. Knowing when to buy your policy is kind of like your secret weapon for keeping costs under control. And that leads us to the number one rule of thumb: buy it early. It is, without a doubt, the simplest and most effective way to lock in a lower rate for life. You see, for the insurance company, a younger, healthier you is a lower risk. And that lower risk translates directly into a lower premium for you. Now, of course, there's a trade-off. As this table shows, yeah, you get those sweet lower monthly payments and a much better shot at qualifying, but you will be paying those premiums for a longer period of time. Still, for anyone who's really serious about managing their future costs, it is an incredibly smart play. But here's the real kicker. It's not just about the money. It's about your health. As we get older, health issues can just pop up out of nowhere. And if you wait too long, you might find you can't get coverage at any price. You could literally be disqualified entirely, and that's a risk you just don't want to take. Now, are you tired of those old use it or lose it policies where it feels like you're just throwing money away if you never need the care? Well, there's a much better way. Let's talk about hybrid policies, which give you the flexibility to combine different kinds of coverage. So let's break down the two main options here. First, there's a hybrid annuity. This lets you invest a lump sum that grows and you can use it for long-term care. And hey, if you don't need the care, it pays out as a death benefit. Then you've got a life insurance policy with a long-term care rider. And think of a rider as just an add-on, like a superpower for your policy. In this case, it lets you use your death benefit for care while you're still living. It's really perfect if you're already thinking about life insurance anyway. But hey, what if you'd rather stick with a traditional policy and just need to make it more affordable? Well, the good news is you are not stuck with the sticker price. You can actually customize your coverage, so let's check out 3 specific ways you can do just that. Here are 3 powerful levers you can pull to bring that premium down. Pick a shorter benefit period, look into a shared care policy if you're in a couple, and think about a plan with a higher deductible. Let's dive into each one real quick. First up, lifetime coverage. It sounds fantastic, but wow, it's incredibly expensive. And get this, here's a surprising fact you see on the screen. Most long-term care claims last less than 3 years. So choosing a 3 or 4 year benefit period is a statistically smart way to lower your premium without taking on a crazy amount of risk. Next, for couples, a shared care policy is a total no-brainer. It's usually cheaper than buying 2 separate policies, and it's super flexible. If one of you needs care for a long time, you can actually tap into the other's pool of benefits. It's a fantastic way to plan together as a team. And finally, think about a high-deductible plan. Sometimes it's called an elimination period. The idea is simple. You agree to cover, say, the first 90 or maybe 180 days of care yourself, and in exchange, you get a much lower monthly premium for the entire life of the policy. It's a great option if you've got savings to cover those first few months. Wow, we have covered a lot of ground. the cost of waiting, timing your purchase, looking at hybrids, and customizing your plan. But if you remember only one single thing from this entire explainer, please make it this. It all boils down to one crucial message. Here it is. Lock in your rate while you're young and healthy. Your health status is just as important as your age when it comes to getting an affordable plan. Seriously, this is not something to kick down the road. You just can't wait until it's too late. So, we've laid it all out for you. We've given you the strategies, the numbers, the whole playbook. Now, the final question really just comes down to you. What's your plan for the future?